If you are after a town that sums up Britain's economic quandary today, there are few more apt than Nottingham. For every part of the city that's new and shining, you'll find another part run down and empty. It's a far cry from the City of London, where the Bank of England governor usually spends his time. And perhaps that's why Mark Carney chose to make his first major speech here, not in the Square Mile.
The 7% threshold is a staging post along the road to recovery. When unemployment reaches 7%, the MPC will reassess the state of the economy and the appropriate stance of monetary policy.
That's the message he's trying to drum in. No rate rises till unemployment drops below 7%. The problem is the markets disagree with him on how soon that will be. The upshot is that real market interest rates, the ones that determine many mortgage rates, are rising, not falling, as he might have hoped.
He's basically trying to say that, listen, the economy is improving, but it does not mean that it's time for us to hit the brakes. We're not going to let the bond market try to lead or force the Bank of England into raising rates. Because if the economy continues to improve and bond yields continue to go up, then that will raise the mortgage rate. And he's trying to stop that from happening.
The entire point of forward guidance is to go over the heads of city analysts and economists and make it very clear to normal people that interest rates are not going up anytime soon. Though it's not immediately clear that message is getting through.
I don't feel secure in anything at the moment, and I don't think many people do. I took a bank loan out last year to keep the business going because there's some competition for the multiples around, and I was charged 19%.
I think I'm getting used to the fact that interest rates have been so low for so long that in fact it's difficult to see a major change.
I think people are frightened. No idea what's going to happen from day to day.
There are three competing angles to today's speech. First, that if the economy disappoints, the bank will consider more stimulus, in other words, more quantitative easing. Second, that there's only a 1 in 3 chance unemployment falls as quickly as markets think. Third, that banks will be allowed to hold a wider variety of assets on their balance sheet in the future. The problem is that even after today's speech, markets put the cost of borrowing even higher. It's becoming rapidly clear that the governor is engaging in a head-on battle with financial markets, and it's one he's determined not to lose. Ed Conway, Sky News in Nottingham.